Today on the Joseph Carlson Show, my portfolio reached an all-new high, and the stock market reached an all-new high. We have lots of people excited about the market reaching a new high. We have Jeremy Siegel calling in, expressing his excitement for the Fed lowering interest rates by 50 basis points. We're going to be looking at why he thinks this is such a good decision from the Fed. We also have news that Amazon is introducing an AI bot for their third-party sellers. Olive Garden just reported their earnings, and it was a huge recovery. The stock price is jumping. And Walmart is taking big steps to battle credit card networks like Visa and Mastercard. We'll be taking a look at what they're doing with these instant bank payments and how it may affect these credit card companies. And then of course we're getting to the weekend, so it's time to check up on Financial TikTok. This one is actually Financial Reels, but it's very similar. This individual shares how he manages to have multiple jobs at the same time that are all high paying, and he built a business doing so. We'll be taking a look at his advice in this episode. Now let's go ahead and move on to the main story. The market is reaching an all-time high, and my portfolio likewise has reached an all-time high on the day. We now have $271,000 in gains, which is incredible. Just today, the portfolio is up 1.63%, which is around $12,000. So it's a big day. For the market, it's a big day, likely for your portfolio. Hopefully you've stayed invested in the market. Hopefully you've ignored all the bears trying to scare you out of the market. In many ways, today's a day that you can celebrate. As investors, I think it's good to have time periods where you're just happy about what's going on with your portfolios. Companies are growing their earnings, companies are gaining value, and the market is rewarding investors taking on this risk. I, for one, am excited about what's going on. I'm excited about what's happening with my companies. The biggest contributors to my portfolio this year have come from 3 different investments. The first one is in the restaurant category, which is Texas Roadhouse. My total gains in Texas Roadhouse are $38,000, but if I filter that just by this year, we can click on the year to date and see that just this year it's up $21,000. That is a huge gain for a single year in a company like this. My next biggest one is in the consumer category. And of course we have the rocket ship, which is Costco. Overall, a $43,000 gain. When I filter just by the year to date, Costco has gone up $21,000, matching Texas Roadhouse's gains. If we look at third place, it's in the financial category. We have S&P Global. Overall, it's up $33,000. If we filter by the year to date, it's up $18,000. This has been another great performer. So those are the companies that have contributed the most to my portfolio this year. Now, if I look at the worst performing holdings in my portfolio this year, I can also outline the top 3. The worst one so far this year is Salesforce. It's down $2,000. This is the only company that I'm in the red. It's the only company I hold that's lost money this year. Next up, we have Vici. Overall, Vici's in the green by around $12,000, so it's been a good holding over the years, but year to date, it just hasn't kept up with the market. If I filter by just this year, it's only up $500. And then the third worst performing position in my portfolio is Canadian Pacific. It's up $4,500 overall. If I filter it by just this year, the company is up $3,600. Overall, again, I can't complain, and I'm very excited about what's going on with my companies. I feel like they've been performing to my expectations, and in some cases, they've been pleasantly surprising me, performing better than I expect. Now, you might say, hey, Joseph, you're excited. You said you're not supposed to get excited when the market goes up. And that's true. In my own investing philosophy, where I go over stock selection and the temperament and the portfolio management to be a great investor, the first thing I outline from investors that have good temperament is they don't get excited when the market goes up. And here I am excited and celebrating that the market's going up. So maybe this needs a little bit more clarification. When I say don't get excited that the market's going up, I don't mean that you need to suppress all joy and emotion when investing. I think it's good to be happy about things, to celebrate landmarks, to be excited when your portfolio is making gains. Where I draw the line in terms of investing is acting excitedly, acting impulsively, piling more into top performing positions by chasing gains. When you translate being excited into acting excited, you start to make dumb decisions. And I think it's time to be careful that we don't use the exuberance in the market and translate that into greed. It's okay to highlight companies that are doing really well, but in some cases that can translate directly into temptation, into pushing all your money further and further into these companies. And I don't believe that's the best investment strategy. Rather, we should take a disciplined approach. We should look at the companies based on their fundamentals and their valuations. We should continually look to invest in the ones that we believe have the best risk and reward. reward. In this case, in my portfolio, I still think that Salesforce is one of the best risk and rewards based on the valuation and growth potential, even though it's the one that has performed the worst year to date. So when I say don't get excited when the market goes up, I don't mean you always have to be somber. I don't mean you always have to have a scowled look on your face. I'm not suggesting we all be like Gurney and Dune.
I am smiling.
It's okay to smile. Being happy about your returns is not going to make you a bad investor. Hubris and emotionally driven decisions are what cause investors to fail. So I am pleased with the way things are going today, and if you've been investing well, you should be too. If we look at what's driving the market today, of course it was the rate cuts that happened yesterday. That's really the one major piece of news that we can attribute this large rally to. Now there is some confusion. The rate cuts happened during market trading yesterday, and the market ended in the red, and then it surged up a day after. It's a little confusing when the market decides to trade down the day that they announced the big rate cuts, but then trade up suddenly the next day. And this goes into all the different driving factors of the market in the short term. There's a lot of things going on behind the scenes. There's some analysts that have looked at this and they've tried to determine why the market went down yesterday and is up today. After closing lower yesterday, the stock market suddenly loves the Federal Reserve's half-point rate cut. It may say more about trading under Fed Chair Jerome Powell than anything about monetary policy. The stock market initially popped following yesterday's rate decision before wild trading took hold. The S&P 500 repeatedly pressed against its highs before pulling back and finishing the day down. So there was a lot of aggressive trading going on yesterday. Charlie Ashley, a portfolio manager at Catalyst Fund, said, quote, "The moves in equities and treasuries right after the announcement indicate that the market is concerned about the economy deteriorating, but today it looks like it's a different story. The market's actions immediately after the Fed announcement tend to be erratic and irrational." Another analyst wrote that on Fed days under Powell, there have been clear negative bias for equities in the final hours of trading, which is again on display yesterday. The truth is that this is all conjecture, opinion, people throwing out their thoughts. The real truth of the matter is we don't know. We don't know why the market ended the day yesterday in the red and is in the green today. Like I've said repeatedly, overall, interest rates going down is mathematically beneficial for stocks. Every investment has a relative value based on other opportunities. Investing is not in a vacuum. Equities are not the only thing that you can buy as an investor. When interest rates go down, it makes other alternative investments like bonds and cash, money market funds, CDs less attractive, and stocks, relatively speaking, more attractive. So it makes sense that the market goes up after a rate cut. The only counter narrative is if the economy goes into a recession. Equities take on more risks during recessions. So investors right now are trying to balance the risk of holding equities and the chance of us going into a recession. But lucky for us, recessions during rate cuts are not necessarily guaranteed. And Jeremy Siegel is an economist and investor that believes there's a good chance we can avoid a recession.
This was the best news I've heard from the Fed in years. And by the way, let me guarantee you an all-time high for the stock market today. There's not going to be a back and forth the way there is yesterday. And the word recalibration is extremely significant. I think what they did is they said, listen, we're 100% towards our target on employment. We've got that back to normal. We're 80 to 100%, depending on what data you use on inflation. And we haven't moved at all until yesterday on the Fed funds. We say, the neutral Fed funds is 2.9%. And, why aren't we closer? We're now thinking about that gap, which is exactly what I talked about a month ago.
Jeremy Siegel believes that this is the best news the Fed could deliver, that they're not worrying about the gradual approach of slowly lowering interest rates down to this target. He says mind the gap, that there's a large gap between where we are now and neutral. Neutral from the Fed standpoint is 2.9%. We're currently around 4.7%. So we have a ways to go to get to that neutral stance. And I think he's certainly correct about more interest rates coming in the future. Now, of course, whenever the Fed is on a path of cutting interest rates like this, investors are not only concerned about combating the growth in unemployment, they're also concerned about reigniting inflation. We have a bit of shell shock from the level of inflation we just went through. And the last thing this country needs is to reignite inflation again.
If inflation shows any signs of picking up and the Fed says, hold off, we're not going to do anything else anymore.
That's correct. But I don't see any sign of inflation picking up. I mean, I took a look at the markets, the oil markets, all those markets going ahead. This Jeff Gundlach was on right afterwards. He said his model actually shows a year-over-year inflation next year when those new shelter numbers come in. It's going to fall below 2%. Now, I don't know if that's going to be the case, but that certainly is not a situation where we're off to the races again. The commodity markets, those sensitive markets, they tell you when you're off to the races. They told me in 2020, 2021, it's a totally different picture today.
Cutting interest rates is unlikely to spur inflation once again, because we're not doing the thing we did a couple years ago originally to cause inflation. Inflation wasn't just caused by supply chain disruptions. It was caused by record levels, trillions of dollars being handed out to people. When you create more demand through stimulus while simultaneously having a shutdown with supply chains, that's obviously going to spur a lot of inflation. We're not giving out record levels of stimulus anymore, and supply chains are back on track. Neither contributing factor that caused inflation originally exists today, so it's unnecessary for the Federal Reserve to keep their interest rates as high as they were when they were combating that inflation. Now, of course, I'm not saying that there's no inflation. There's always going to be a low amount of inflation, 2 to 3%. That's on any given year, and our government does that to lower the value of our staggering amounts of debt. So we should expect a constant amount of low inflation, and the assets that we invest in help protect us against that inflation. But overall, I think Jeremy Siegel is correct that we're not facing hyperinflation. I don't think it's going to go back up like it was during 2020, and I think there's more reason to be bullish on this market. So as of right now, I'm excited, I'm staying invested, and I'll continue to buy companies that I think represent good value. Now moving on, we get to the news that Amazon continues to roll out generative AI-based assistants and tools. For a company that's not a so-called AI company, Amazon really never gets grouped into that basket. It's usually Microsoft or Google. People avoid calling Amazon an AI company, and it sure seems like Amazon's coming out with a lot of AI tools for a not AI company. This latest one is a project codenamed Amelia. Amazon introduces this by saying that they've been investing in machine learning and AI for more than 25 years. More recently, advancements in generative AI have made it possible to deliver even more innovative experiences, including further simplifying selling in Amazon stores while providing more powerful avenues for growth. Now again, this bot, Amelia, is not a customer-facing bot. Customers don't see it. This is only for sellers on Amazon. And from what I can see, it's a trained bot on a large language model to look at your data and give you specific answers to questions about your store. You can ask it how your sales are doing or how your products are doing, what your click-through rates. Lots of different things about the analytics. This tool gives sellers the ability to just type stuff like, how's my business doing? And then it gives a bulleted point of the sales, units sold, selling price, the amount of traffic, the changes month over month and year over year. And then it gives a plain text summary adding commentary to how your business is doing. Overall, your business is doing well with impressive growth across key metrics like sales, unit, and traffic. While conversion rate could be optimized, the strong momentum positions you well for the upcoming holiday season. Now, of course, this is their demo and it's in beta right now, but if this thing runs anywhere close to like these demos, this is going to be a game changer to sellers. Not every seller on Amazon is a data analyst that can decipher all the metrics and determine the biggest things to focus on. So having an AI bot do that for you could be invaluable. Now you know that I've been bullish on Amazon for a while. I really like the company both from a customer perspective and from an investment standpoint. I still believe that Amazon is one of the more undervalued companies in the market based on my assumptions of its long-term cash flow growth and terminal value. So when I see news like this today with the growing fundamentals of Amazon, it makes me more happy about the company. Now we move on to a story that's a bit more concerning if you're invested in the payment card networks like Visa, Mastercard. Apparently Walmart is planning instant bank payments that would completely circumvent going through Visa and Mastercard. Walmart customers will soon have the option to pay directly from their bank account with instant transfers for online purchases. The enhanced feature is a flashpoint in the escalating tensions between the merchants and the card networks setting the fees for payment processing. So basically what they've done here is found a way to speed up the ACH transfer, so it no longer has that 2 to 3 business days pending transaction. When the transaction processes at a real-time payment, customers get immediate access to see that payment come through. So they see the payment come through, and then they know how much money they actually have. They have no pending transactions. Pending transactions can make it so customers get their payments confused and in many cases overdraft their accounts. Now, the big question for me when reading this news of trying to circumvent Visa Mastercard is the rewards program. Using Visa Mastercard at merchants like Walmart is an essentially free way to get rewards from those purchases. You get 2 to 3% back on every purchase. Is Walmart going to make up for that loss in rewards? Is Walmart going to offer a separate reward program? Now, as an investor of Mastercard, I think it's important to ask what the potential is for this in the future. If it is true that Walmart and other large retailers can completely surpass their networks, that's not good news for them. That's hundreds of billions of dollars of volume processed that Mastercard could potentially miss. But I think this will be much more difficult than Walmart expects. People really love their credit cards. It is difficult to pry a credit card from a user that's been using it for years. They want to use it on their transactions. They want to earn the points on the specific card that they've chosen. So this is some news where I put in the basket of keeping an eye on it. It is slow, progressive news that could, over time, potentially deteriorate the moat of Mastercard, but as of right now, it's just a headline. Now moving on, we get to the news that Darden Restaurants, the owner of Olive Garden, is jumping today. The stock is up big. In fact, if we look at it right now, it's up 8.83%. So a big day for this company after they reported their earnings. This is an exciting earnings for this company. They announced a delivery partnership with Uber Technologies. That's another company that I'm rather bullish on right now. And they've signaled that they're succeeding at attracting cash-strapped consumers into their eateries. They say that this recovery led to them maintaining their full-year guidance despite a significant drop in customers in July. The deal between Olive Garden and Uber also signals that the restaurant chain is trying to expand its reach as it battles the spending pullback. Now, the thing that I look at with this is it's great to see that Darden is doing well. In many cases, people would look at this and they'd think, wow, I own Texas Roadhouse. Should I be concerned about this? A competitor is doing well compared to Texas Roadhouse? I don't think so. When I look at Darden Restaurant and I compare both the restaurant, the operations, the value proposition, the customer experience to Texas Roadhouse, I consider Texas Roadhouse as superior. I believe the value proposition is better at Texas Roadhouse. You get food that's considered to be higher quality, more expensive food. You're getting steaks instead of spaghetti. And typically, if you compare the dinner prices from one restaurant to another, you're also not paying much, if not any more, at Texas Roadhouse. So in the minds of consumers, I still believe that Texas Roadhouse maintains the best value proposition amongst casual restaurants. But either way, when I'm looking at these companies and the bounce back in restaurants between Chili's and Darden, I consider that a good thing. I think it benefits Texas Roadhouse. It shows that customers right now are willing to go out and purchase experiences. And I believe Texas Roadhouse will continue to carve itself out as one of the top restaurants that people frequent. Now finally, as tradition, typically on weekends, we look at people that are entrepreneurs, that are investors, that have somehow managed to make great returns doing something. And we're gonna look at how this individual became rich.
So basically I built a business using Airbnb and other people's properties to make money. And then I got a job at Deloitte as an investment banker. Deloitte is a world famous investment banking company. And I used my extra time, because I built like a 4-hour work week business, to get a job 40, 50, 60 hours a week.
I don't hear of many people running businesses that require 4 hours a week to run. That seems like an incredible business. I'd probably just invest more time into expanding that business. If it's that efficient, you only need 4 hours a week to run it. Just spend more time in that thing. Anyway, it seems like he's not done here. Let's let him continue on.
I use that 60 hours to generate money to do amazing things like this. And then actually what I'm doing at the moment is I'm negotiating a remote job with Deloitte so I can get a job at Ernst & Young and Swiss Bank so I can get multiple remote jobs going. And then I'm going to hire assistants overseas to do those jobs for me because I find all of that stuff very complicated.
He says he's going to use his free time after starting his business that requires 4 hours per week to run. He's going to use all the extra free time to get a job at Deloitte, which is one of the big, massive, big four firms in the US. So it's a big, respectable firm. Getting a job there is not easy. Requires intense background checks and extensive interviewing processes to get a job at that firm. But then he also says he's going to simultaneously interview and get a job at Ernst & Young, which is another one of the big four firms in the US, which again requires an extensive application process, interview process, background checks, all of that stuff. Those are two of the big four firms in the US. And then he says he's also going to get a third job at the Swiss bank, which is a term to refer to any of the big banks over there, which of course have their own extensive interview processes. Somehow he's going to get a job and get accepted at all three of these companies. But not only that, he says once he has the job, he's going to outsource it.
Assistants overseas to do those jobs for me because I find all of that stuff very complicated.
Apparently, overseas assistants can easily do these jobs, even though he says that they're complicated. If there's any trend that really needs to die, it's the one where someone stands next to something that's kind of sort of impressive or something that's kind of expensive and then rattles off a bunch of nonsense things while they're standing next to it. In this case, the individual is on a boat with three women in the background. That's what he's doing that's so impressive. That's supposed to get you to buy in to what he's saying. Does he know the women? Who knows? Is this boat his? Probably not. But that's supposed to be enough to convince you to buy into whatever garbage he's selling. I think we need to do better. More people need to call this stuff out. More people need to mock it because of how ridiculous it is. And hopefully we can change this in the future. Hopefully we can make this type of nonsense less prevalent. Now that's going to be it for this episode. I hope you enjoyed, and I'll see you in the next one.